All right, good evening, guys. Ken at Tortoise Capital. This is the Friday night strategy podcast for April 7th, 2023. So the market was closed today, so we don't have coaching or sniper trades. So I'm going to go through the report in detail, section by section, just to give you an integrated look at all the different pieces and parts of the report. So the report is really like a salad bar for a lot of different strategies. You should be using this report to find the information that you need for your particular style and concentrate on those things. So the weekend report consists of a once a week weekend that has some strategy and longer term insights. Then it gives a 2-page update that uses the ETF2 database, which is a particular style of evaluating current relative strength, a 10-week rolling relative strength, a 40-week quality index. All three of those are proprietary to us, unique to us, that give us a longer-term momentum-based and volatility-based insight into several hundred symbols in the ETF world model. And then finally, the third section is would be the daily report that was done today, in this case for Monday. So it really just includes the Friday report for the Monday open. So you get those three parts in the standard weekly report. What you get on the third piece is really just the regular daily report, okay? So the very first thing that I look at on the weekend report and the daily report, you'll see, is the market classification, and it has a 9-part. It looks at bullish, sideways, and bearish. It looks at volatile, normal, and quiet. The way we compute the bullish, sideways, and bearish is unique to us. So it turns out that if you look at the 200-day moving average, that when price is above the 200-day moving average, that's considered to be bullish. And when the price is below the 200-day moving average, that's considered to be bearish. Now, how do we know that? Because I've gone back 30 years of daily bars and updated. And then I've done the statistics on what tomorrow's performance looks like on average based on whether today was bullish or sideways or bearish. Now, I added a refinement here. By inspection, we were able to say, look, when price is within 2%, plus or minus 2% of the 200-day moving average, we call that sideways. Now, we call that sideways because tomorrow, on average, is zero. There's no, on average, the difference between today's price and tomorrow's price, on average, is zero. So there's no advantage to holding overnight on the basis of market condition when it closes inside that 2% band around the 200-day moving average. Now, when you look at the price may actually have been going up or it may have been going down, but if it was within that 2% band, the next day on average has been flat. And so, because the next day's expectation is flat, I have labeled that as sideways. You're not ever going to see that in anybody else's market classification that I've seen. That's important because when we are considering whether or not to hold overnight risk, we can use that to get a statistics-based view of the advantage of holding overnight or not. So here's what we did. Now we have those three classifications. So now if it's greater than 2% above the 200-day moving average, we call that a bull. And we call it, if it's in that band, sideways. And if it's below that, more than 2% below, we call it bear. So here's what I did. We take 30 years of data, and there's 260 days in a trading year. So you multiply that out, and you get 7,800 days. So we go back 7,800 days. And in order to compute the 200-day moving average, you have to actually go back 8,000 days, so that on day 7,800 you have a 200-day moving average to compare that against. And then for each one of those 7,800 days, we put it in a bucket of bullish, sideways, and bearish. And then when we put all those days in there, we then take the average of that, and the average of sideways, and the average of bullish. And what we found was that when the market closes in bullish territory today, tomorrow on average is up. If it's within 2% of the 200-day moving average, tomorrow on average is flat. If it's more than 2% below the 200-day moving average, in other words, if it's bear, tomorrow on average is down. And on that basis, we're able to say that that bullish is favorable, sideways is neither good nor bad, and that bearish is negative. So that's good. That's one of the dimensions. Now, the next one is we care about market volatility. First of all, let me ask if there's any questions on that. So now we're looking at volatile, normal, and quiet. So I started off by trying to understand volatility in the following way. And I did that. Yes, this is all SPY, because everything that we trade is strongly correlated to the S&P, generally speaking. It's also possible to do this math on individual symbols. That's a different story for a different day. Now, when I look at volatility, this is how I look at it. Volatility changes from quiet to volatile to normal very fast. And so what I look at is the relative volatility compared to recent memory. Because this is so emotion driven, what I do is I use 100 days of look back to establish the context of what constitutes volatile, normal, and quiet. And what I do is I take the range percentage, as you were. I take the ATR, I forget what I was doing, the ATR percentage of the 14-day look back. So average true range is a 14-day look back, and it computes a volatility percentage based on the summary of volatility in those 14 days. So if I want to find the ATR today, I go back 14 days. Math is performed. It comes up with a number that includes the size of the daily range and the amount of gap that there was in each of those 14 days. And then it produces an average of that true range. And then in order to find a percentage, we take the ATR and divide it by price, and that's going to yield a percentage. Now you want the ATR percentage because that will allow you to compare volatility over long periods of time. Like if I go back 3 years and see what it was, I go this year and see what it was. And here's the example over on the right-hand side. If you just look at the ATR, and if the price was 50 and it was moving $2 of average true range a day, that would be a 4% price movement would be normal each day, 2 divided by 50. If that same price chart now moved up and then 6 months later it was at 100. And if I look down here at the indicator and the ATR stayed constantly at $2 for that entire 6-month period from when it was 50 to when it was 100, you would look at that and your mammal intuition would be, oh, ATR hasn't changed. It's the same volatility. However, if you take 2 and divide it by 100, now you realize that the ATR percentage is half. So even though price is going up, and even though ATR looks flat numerically, you actually have 1/2 of the volatility here at 100 than you had at 50. So in order to compare volatility over time, you have to use ATR percentage in order to do that. So that's how we compute it. ATR divided by price gives you a percentage. So now what we do is I go back 100 days. So minus 100, and then today's -1 when it closes. Now to get the ATR of the day minus 100, I actually had to go back 14 days in order to compute the ATR percentage of that time period in order to come up with the ATR percentage of day minus 100. Check or hold? Okay, so now what we do is we then march that forward, and for each of those 100 days, we compute the ATR percentage of each of those 100 days. We then can rank that and put statistics on it, and what we're going to do is we're going to find the max, the min, the average, and then the standard deviation, in order to compute a range of normal. So the range of normal is going to be from +1 to -1 standard deviation around the average. So the way math works, about 2/3 of the data falls between average and ±1 standard deviation, and about 1/6 of the data is between average +1 to the max and average -1 down to the min. All right? So 2/3 of the data is here stuck in the middle. We would call that normal volatility. And then volatile is the upper 1/6, and quiet would be the bottom 1/6. Check or hold? So that was my initial sorting scheme. I went back the same number of 7,800 days, and for each one of those days, I put it into 3 buckets. We based on that 100-day look back in that local time period, it was either volatile or normal or quiet. And then we did the same thing. When today closed volatile, what was tomorrow's return? And if it was normal and if it was quiet. And what we found out was that quiet was very good, that normal was pretty close to positive and plus a little bit because the market has a bullish tendency, but when it was volatile, it was kind of flat because when it's volatile, you get very large losing days the next day, which offsets many. So somebody asked me, why 100? Because I just picked 100 for local context. It felt right, and I tested it to see if it would work. It worked, and so I stayed with it and have stayed with it for 25 years. There's any other number of those things that you can use, but as long as it's consistent and has a reasonable length, then you're justified in making statistical inferences. I used 100 because you need at least 30 in order to perform statistics, so I thought I'd go 3 times more, and 100 was a nice round number. And I didn't see anybody else ever using that strategy, and it felt like it was going to give me a good enough insight to get started. And what I discovered was my intuition was good enough that I could make bank on it. So now we know that that bullish, sideways, and bearish independently give you plus, flat, and minus. And now we know that volatile, normal, and quiet gives you about flat, positive, and positive. So now I'm ready to put those into a combined matrix that now has 9 categories. So what we have to do in that case is now I have to build 9 buckets. 1, 2, 3, 4, 5, 6, 7, 8, 9. Because for each one of those 7,800 days of look back, I have to compute how many days closed bullish volatile, bullish normal, and bullish quiet. And the same thing with sideways and bearish. So I get 9 different buckets, and I have to test those independently to see that when I make it 2 variables, what are the relationships? Well, when we did that, what it turns out is that there are 4 market conditions in which tomorrow, on average, is up. And that turns out to be every bull and sideways quiet. It turns out that those conditions, historically, the following day is positive. And it turns out that 3 of them are negative, and that is bearish, volatile, normal, and quiet. Any bear, on average, tomorrow is down. And then it turns out that sideways volatile and sideways normal, on average, tomorrow is flat. So when I'm considering whether or not to favor swing trading or to hold positions overnight with symbols that are strongly correlated to the S&P, I use this as a guide to give me a general sense of what the market will bear. And so lately we've had very sideways and bearish markets, and that means that the shorter term intraday trading is favored. And it's better to take a bird in the hand than try to hold out for more tomorrow because of those very numbers. So the very first thing that I look at on my daily and weekend reports is the market classification. The next thing that I look at has to do with trade location. And in this case, I'm using a multi-time frame NDX. So the NDX is our name for the tortoise index. And that looks very much similar to Williams %R. There are 2 problems with Williams %R. If I just look at a 10-day period, Williams %R uses today's data, the 0-day, and it goes back 9 days to give you a total of 10 days. It then finds the highest high in that time period, right there, and then it searches for the lowest low, and now it gives you a range. And for reasons unknown to me, Larry Williams said if today closed at the highest high of the last 10 days, Williams %R would have a value of 0. And if it closed at the bottom, it would have a score of minus 100. So when you see the market close with a %R, it will tell you where it closed within a range of from 0 to 100 based on like a thermometer scale. The interpretation of that is that the 50-yard line, minus 50, which is the mathematical center of that, is at minus 50. And then the way that's interpreted is for oversold conditions, it goes from scores of minus 80 to minus 100. And then overbought is considered to be in the upper 20%. from minus 20 to 0. And then everything in the middle is considered just to be within the normal range, and that's between minus 80 and minus 20. So we would think of that as normal. This would be overbought, and this would be oversold. So are we clear on Williams percent R? Now, there's two problems that I have seen with Williams percent R. The first one is that the scoring from 0 to minus 100 feels really unnatural to me. If I was going to do it, I would do it from 0 to 100 affirmatively, like a thermometer, because that feels like a normal percent fill, if you will. So I wanted to use a change so that I could get the score from 0 to 100. Now, the second problem I have is that today's date, or today's price action, when you include that inside the look-back period, what happens if today, or if the last 9 days were very tightly bunched, but today gapped up and then moved way up and closed way up here? Because Williams percent R includes that in the look-back period, and it closes up here, you would look at that and say, oh, that's probably like minus 10 because it's in the top 10%. And you would just think, oh, it closed near the top of its range, which it did, but you would have no idea that something really powerful and abnormal happened, which was a big gap and a large move. You wouldn't know that just by looking at two symbols, let's say Alcoa and Cliff, and they both had a reading of minus 10 on Williams percent R. You wouldn't know what that chart pattern looks like. So in order to fix that, what I do is I look back 10 days, but I start at the minus 1 day, and I go back to the minus 10. And then the 0 day, which is today, I do not include as part of that range box. So what I do on any given day is I go from minus 1 to minus 10, set that equal to 100 and to 0, using the same generic boundaries. But then I can look at today's price action, and if that's where it closed, I can now find the closing price and link it up to the index, and in this case it looks like 80. And now I can tell you that compared to the previous 10 days, today's price action was within that 10-day period. But if today's price action jumped up here and closed well outside of it, it's possible in the index to get a score greater than 100. Well, why is that? Because this is the score of 100 based on the previous high. It may look like this. And that score is 100. But because this closed up here, what you have to do is you have to extend the scale. And what you end up doing is taking the unit of measure here, that's equal to 100. In this case, it looks like it moved up to a reading of 200. Why? Because the size of this 10-day range, it moved that far as a breakout. So now when I take a look at a stack of numbers, and I'm looking at the 10-day NDX, I will see, and then I rank it by biggest to smallest. It's not unusual for me to see a bunch of symbols between 0 and 100, but there may be some that had breakouts of their 10-day period, and then I can see that because the score is greater than 100. And then on the basis of how big that number is, I can tell you how big the breakout was. So a score of 200 is an enormous breakout. A score of 110 would have broken out just a little bit. And so from a single column of numbers, I can tell you which ones are within the range of normal, which ones are above or below the 50-yard line, which ones are between, let's call it 20 and 0. So this is just normal oversold between 20 and 0. Which ones are normally overbought? Let's call that between 80 and 100. And then I like to put a 4-color code in there. So right at the 50-yard line, things that are between 50 and 20, I just like to color those yellow so I know they're in the bottom half of normal. And then if they're between 50 and 80, I just leave that the color of white. So now I can tell you from a single column of numbers with the NDX, were there any breakouts and how big were they? Were there any breakdowns and how big were they? And then where inside this previously normal range are the prices normally located by 4 color codes. So now what I do is I take a look at a multi-time frame NDX, and I look at a 2-day cycle for short term. I look at a 2-week or 10-day look back for guiding my fast swing trading. I look at the last 30 days, about 6 weeks of trading days, for the midterm slow swing, long position trading, 90-day, and then 270 for the long-term buy and hold. You'll notice that the 10 to 30 to 90 to 270 also turns out to be the same numbers that we use for the moving regression lines. So now I can actually take a look at multiple time periods and determine for each one of those where the price is located depending on a variety of look-back periods. And then I color code them. So now what I can see where we are is that we are above average on the long term and that we've had a surge of recent strength over 2 days, 10 days, and 30 days. So now I have a trade location to go along with my market classification, and this is all based on SPY. And now I have a feel for what the market conditions are. Now, why do I do that? Because the things that I trade, the S&P or the market is worth about 50% of the returns that the individual stocks and ETFs get. And then the sector that it's in accounts for about 25% of its variation, and then the individual company is worth about 25%. So if I get the market condition call right and I'm aligned with the market, then I've got half my work done for most of the symbols that I trade in. So if I look at 50 to 60 symbols for actively trading, and I can get a good insight on half of their movement for all of them with a single set of indicators, then I have become very efficient in understanding what is influencing their price behavior. So that's the first two things that I look at: market classification and the NDX. Check or hold. There's a couple info papers in the Foundations course where you can reread what I just said with words on a page. Sometimes it's easier to hear. Now, the next thing that I look at is this section over here. These are some additional market mosaic factors that give me some additional insights into characteristics of the market based on SPY. Now, this reading right here is, I'm looking at the 200-day moving average, and you can see what I'm looking at is price relative to the long-term trend. And the current reading is that it's at 3.98% above the 200-day moving average. And as you recall, if that's the 200-day moving average, I have a 2% threshold, plus or minus, in which this thing could be sideways. But right now that reading is at, if this is where price is, it's at 3.98%. That means it is almost 2% into the bullish. And so that gets a bullish rating, and this bullish rating here is why this is reading bullish over on this indicator. Check or hold. Now the next thing that I do is I color code that, and that can have 4 different color codes. Because I want to know how strong is this compared to the last 180 days. So I'm going to go back and look at the last 180 days, and I'm going to look at that value, and no matter whether it's bullish or not, if it's in the top 1/6, that's going to get a color code of green. And if it's within the upper one half, it's going to get a color code of white. And if it's in the lower half of normal, it's going to get a color code of yellow. And if it's among the worst performers of the last 180 days, it's going to get a color code of red. So when I see green bullish, I know not only is this value above, more than 2% above the 200-day moving average, the fact that this green says this is one of the best readings of the last 180 days. Now, if we had had a 200-day moving average that looked like this and price was way up here and then came way back, that thing might have actually read as white because it was no longer in the upper 1/6. It could have been well above the 200, but because it's not as good as it once was, it would not have also gotten a green color code. So just from that little indicator, I can tell you how extremely good or bad this individual rating is. Next one. The ADX14 is a measure of intermediate strength of trend. It looks at a 14-day look-back period, and we set thresholds of 25 or greater in order to be strongly trending. It's unusual for the S&P to get stronger than 35. That would be very strong. And then between at less than 15, this becomes non-trending or sideways choppy. So between 25 and 15, this would be normally trending or not strong at all. So right now the reading is 28. So the upward move in the S&P is actually categorized as a strongly upward trending bullish move. Right now the ATR percentage is 1.83, and then compared to the last 100 days, that puts it in normal. And this normal is how you get this normal. And I've explained how we compute that. Now here's what I will tell you. Before the internet boom in 2003, the average volatility of the S&P was about 0.7%. So a reading of 1% would have gotten you a volatile market. But right now, the recent volatility has been so large that 1.83 is considered normal compared to the last 180 days. It turns out that volatility goes through cycles, and that what feels like normal today may have been quiet 6 months ago, or it may have been volatile 6 months ago. Our memory of how volatile things are is a very fragile thing. It is not very well calibrated at all. And so if you use an adaptive measure of volatility that is pretty sensitive, like 100 days of context, you will be able to detect changes in the market's volatility at a significant level that other people will not see. The next thing I look at is what I call the risk index. Now, there was a paper about 20 years ago in the Journal of Financial Engineering, and what they did was looked at the value of the VIX. So the VIX is the volatility index, that is the implied volatility at the Chicago Board of Exchange for S&P futures. When the traders believe that the market is fragile, they will pay a higher price to buy insurance contracts against volatility, and that will that reading, that pressure to buy and the rising price of those options will drive the VIX higher. So now what we can do is I can now go back and track the VIX. And it turns out that the VIX looks like this. It just monkeys around, and then it gets nervous, and the price shoots way up of the VIX, and then it slowly decays into normal. It may even get quiet, and then it spikes almost like a heartbeat. When you see values that have a quality like that, what these guys did was they took a 30-period moving average. So let's say here and out to 30 days. And if we took the average of those prices, we would see that the average is right here. So the 30-period moving average on this day is located, let's call it right there. And so the 30-period moving average looks like this. Now the 10-period moving average is normally lower. I'm going to put that in blue. The 10-period moving average is usually lower because the last 10 days are lower than the previous 30. So under normal conditions, when volatility is decaying, the 10-period moving average is lower than the 30. But when you get up here to the spiky condition, it turns out that the 10-period is quick to move up, and then the 30-period is slow because it has more data to overcome, so it lags more. And so during the period of high volatility, the 10-period average of the VIX is greater than the 30-period average of the VIX, until it starts to decay, and then the 10 rolls over and goes pretty quick, and then the 30 crosses over, and now it decays. Now, during periods of declining volatility, this is actually, this period of time here of declining volatility, that's good for stocks. And when volatility is climbing, that's bad for stocks. Well, what these guys did in that paper was they showed us that that condition could be used as a form of market timing based on volatility, based on the VIX. So what we do is we take the 30-period moving average of the VIX and divide it by the 10-period. Now, when those things are perfectly identical, so when the 30 MA is divided by the 10 MA, when they are equal, like right here and right here, that index has a value of 1.0. When volatility is declining, the 30 period is higher, the 30 period is greater than the 10 because it's north. And so when volatility is declining, that reading will be greater than 1. And when the 10 period is higher than the 30, that number will be less than 1. So we can use that as a volatility measure of market conditions. So what did we do? We went back 20 years and we computed the risk index, the 30 MA divided by the 10 for the last 20 years, and we said, on average, what is tomorrow based on that reading? And their paper turned out to be true, that when the risk index is below 1, it's worse performance than the risk index is above 1. So what we did was we found the max, the min, the average, and then plus or minus 1 standard deviation, and we use that to classify risk on and risk off. And now we can plot that on this scale. And when you get more than 1 standard deviation away from normal, you have exceptional conditions. And then when it reverses, it turns out that this is when volatility is starting to decline. Even though it was really bad, this turns out to be the spring of declining volatility. And when it gets above the 0 line, you have confirmation that it is in the summer. It turns out that you can get a front run that once this thing stops going down and starts to reverse back up, you can actually begin to start your swing trade posturing, and you can continue to swing trade on the long side until it gets up into here and the summer peaks. And then we consider this region when it's above the zero line but decaying as the fall. Now, this is not a reason to get out, but it is a reason to be careful about your stops and to watch exactly what your exposure on swing trading is. And when it goes below the zero line, my friends, you want to be a short-term, short intraday trader, and you don't want to be initiating long side trades. So if you watch Tim's live trading Kansas City and research weekend, you will see when we first brought this to the public's attention. So I use this one as a way to understand volatility dynamics with respect to swing trading exposure and when I want to be anticipating market turns. Anytime it gets past 1 or -1, you have abnormal conditions, and you got to be ready for sharp reversals in either direction. But you can start swing trading in the spring all the way through the summer, be careful in the fall, and then exploit the winter for short-term intraday trading. Check or hold? This table here simply gives us the way to compute the standard deviations, and this is such a good oscillating indicator. It smooths all that down, and what you need to understand is we read it exactly the same way that we do the MACD histogram. It has the same meaning for us, that winter bad, a reversal into the spring is tentatively good, summer is best, fall is cautionary, and if you spend only a little bit of time in the winter and resume, that's very good. And if you go winter, spring, and then it goes right back into winter without ever that's really bad for stocks, and that's a great signal on the short side. Check or hold? Yeah, Griff, exactly right. So what we have is a market mosaic here. We have market classification, we have trade location, we have further statistics here, we have the risk index. All of these things together are to give you some insights into that magical mystery beast that is the S&P. When you're looking at the weather and the climate, you don't just look at one thing. You actually have to get a little bit of subtlety and understand all of the things that can be pushing markets around. And when you see things starting to line up in more than one indicator, it gives you more insights into how much risk you want to take on. Here's the next section I want to talk about. So this is the blended monthly rebalancing. So we have 3 time frames. We have core, swing, and day trading. Each has its own set of strategies. We also have what we would call hybrid trading, which is a blend of 2 or more of these. Like sometimes the strong core positions, long-term buy and hold, monthly adjustments, those can also be very good things to swing trade if you take a look at their chart patterns, and when they're really working, you have the long-term benefit and a short-term swing momentum, and hybrid trading can be very lucrative in the same way that swing and day trading, when you hybrid that. You see me trading all the time with the 30-minute, which is right in between swing and day. Sometimes our day trades get so good that we carry them overnight into swing trades. Sometimes the swing trade patterns we have give us insights into which targets are excellent for trading intraday. So when you combine those 3 different styles, you get what we think of as hybrid trading. Now, the core systems feature asset allocation, long-term buy and hold, portfolio rebalancing, and then a particular strategy that we use called the blended monthly rebalancing, which is my favorite approach to long-term core holdings. And those get adjusted on a monthly basis. according to some rules that are taught in the course that we feature for the last 15 years at VTI, and the model still works. And you could use the ETF 13, the 22, or the 32 portfolios. And you can also tailor that for your own particular methods. Some of the consulting that I do with pension fund managers and large hedge funds have to do with fine-tuning various portfolios, and sometimes we have ones where when markets are poor and we are wanting to be in cash, what are some things that we can use for defensive plays, and what are some things that we can use for growth conditions, and then based on market conditions we favor one model portfolio over the other, and we can have rules to blend. That's the work that I do consulting with individual hedge funds and pension fund managers. For our purposes, these are pretty good approximations of the simplest to more complex. I also, since I'm there and I'm computing these numbers anyway, I also take a look at what's going on in the Dow, the ETF 200, and then the ETF Max portfolio set, which is about 300 different ETFs. I want to know which ones in those populations are rising to the top based on the rules of the ETF 2 model, which is used for blended monthly rebalancing. So not only is that core system a reasonable way to approach long-term trading, it also provides week-to-week insights into the relative strength, the 10-week rolling relative strength, and the volatility quality measures of all these different components. So sometimes systems give us signals, sometimes systems give us information about the market through that particular lens. So one of the lenses that I look at is the use of the blended monthly rebalancing lens. That is actually another way to gain insights into market conditions. Like I can look at this right now and tell you that the NASDAQ, the S&P Tech are dominating, and then all of these other ones are globals. So I can tell you that the world market leaders right now is U.S. technology plus the Euro-Asia and European large caps, not the S&P, not the DIA. So this is yet another way to gain more insights into market conditions. So these are the things that we're holding for April, and we held them in March as well, and the performance of the tech and the globals dominated in those periods. Well, if I'm already committed to holding these for a month, I can actually call them up on a chart and see, is there some kind of COTA 2 action that's going on that I might be able to get a turbo boost while it's in this long-term upward outperformance? Yes, I can. That's what we call hybrid trading on the longer term. I'll show you how what the rule sets look like for that and how we compute the numbers. Now there is another conservative swing trade system that we have called ETF2. It uses the same market and index classification system as blended monthly, but it makes weekly decisions on a portfolio of positions to hold. It has an additional market exposure algorithm which takes a look at 10 indexes in the world market model, 4 of which are in the U.S., SPY, the Qs, the mid caps, and the small caps, and it has about 60% in globals. And what that model does is it takes a look at price today and it compares it to the 4-month moving average. And if the 4-month moving average is here and price is above it, then it is it's money that you can afford to have at risk. If that index is below the 4-month moving average, it recommends that you should be in cash. And then each one of these 10 indexes controls 10% of the total exposure to the world. Now, why did we pick 6 and 4? Because the U.S. market is worth about 48% of the global market capitalization, and the non-U.S. represents about 52%, and the trend is going more towards the increase in the size of the non-U.S. So we have the U.S. control 40%, the globals control 60%, and then each one gets a 10% control of the overall asset. So like right now, 6 of those 10 indexes are above their 4-month moving average. So that model recommends that the maximum exposure you should consider is about 60%. When all of those indexes are above their 4-month individual moving average, then that goes to 100. It turns out that this little risk manager is a really powerful feature of the ETF2 system. Now, the ETF2 system, I'm really proud to announce that in the 3 market collapses that we've seen since the year 2000, the internet bubble bursting, long-term capital management, actually there's 4, there was COVID, and then there was the global financial meltdown. In each one of those 4 conditions, the broad indexes lost more than 50%. In this case, it was 80%. The worst performance of ETF2 using this market algorithm was 6%, was the maximum drawdown of real dollars, not peak to trough, but the lowest it ever scored was minus 6% in a world in which 4 times in 23 years we've seen losses of more than 50%. So I pay very close attention to that posture of the global market risk conditions. That's another way that I get market mosaic. What's working? What are the conditions? What are the specifications? What's the volatility? All of these things are always on page 1 of my weekend review so that I can get a feel for what's going on in the world all around us. And that sets my view about what to do in the world for the week ahead. Check or hold. So that's page 1 of 45. Now, the next couple things that I do are market health checks, and I'm looking at various time frames to get a feel for the flow of price using regression lines. Now, this one I call the RLFF daily, the regression line fractal framework, and it's based on 4 moving regression lines: the 10 in blue, the 30, the 90, and the 270. Now, you will recognize, let me see if I can get that in the, how do I do that? Yeah. The 10 and the 30 is the fast pair. And those are separated by a factor of 3. 10 times 3 gets you to 30. 30 times 3 gets you to 90. 90 times 3 gets you to 270. So it turns out that these have a fractal relationship. So the 10 and the 30 are the fast pair, and the 10 is the fast member of the fast pair. And the 30 is the slow member of the fast pair. And now the 30 and the 90 is a pair. And the 30 is the fast member of the medium pair, and 90. And now if I do it by another factor of 3, the 90-270 pair is the slow pair. And this gives me, for longer term buy and hold, a fast and a slow, but which take a lot of data and are slow to move like glaciers. Like if you look over here on the chart, you'll see the blue line is the RL10, and that moves like price. That is our proxy for price. Look how fast that thing moves. The slower one, the 30, is the health of that trend. Look how nice and slow. When that turns, you get owl patterns. And so that is even slower. Now look at how smooth the green line is for the 90. There's a peak, a second leg down, an intermediate low, and then a really nice move up, which allowed us to capture some of that. And when it rolls over, you still have time to capture that on the downside. And so I can now look at the health of the trend on the next time frame at these key turning points in the 90. Now this is really key. Look how the 90 is already starting to rise. That actually looks like a Kata 2 formation in the RL90, which wants to go up. That's very favorable, particularly when price, the RL10, gets above the peak of the 90. That is very favorable. When this breaks, the next thing I can look at is this peak as a price target, as a price target, as a price target. And this is the all-time high. And so we have come about 50% off the low, and now we got another leg higher. So I can look at the flow, the slope, and the turning points of the regression lines, and this sets up our regression line fractal framework. You will recall, if you were listening in on the nightly podcast back in November, what we said was this was a really important moment because the 90 was starting to roll up, and that the price improvement that we saw in here was powerful enough to make the 270 flatten out and start to rise. And we knew that there was more strength in that market because the distance between the 90 and the 270 was beginning to widen. And then we got concerned in here because it was starting to collapse. And now it only got this close, and now the 90 is starting to rise again. This feels like the second leg up, and now I have more positive feelings about the potential of the market going ahead. I also notice that the 270, which has been failing since February 2001, has made a bottom, has flattened out, and is actually starting to get favorable. This is a very important long-term posture. Check or hold. So the RLFF is one of the ways that we use these regression lines to estimate market conditions and look for opportunities. I'll take this moment to say that the 10 period represents the trader's price, and the 270 represents long-term buy and hold fair value. And we use that as an estimate. And this is the trader's price. Now I want you to notice that right here at the very peak, all of those regression lines were together. And then the next thing that happened was that the RL10, the price, got slammed and came all the way down here. And then it couldn't go any further. So one of the ways that we can interpret that is to say that this is how far the traders were able to push the price against the long-term buy and holders. That's how much power traders had to move price. And then the buyers came in because that felt extreme, and they got this far, but they couldn't close to the 270, and it fell. So here's another maximum excursion away from the 270, and that is just about the same distance as this one. So that tells you that the traders in that market have about that much power. They can move it from 470 to 410. So they can move it about $60 on 420, so they can move it about 15% before it recovers. Now, notice on this next one. One leg, two legs, three legs, and here's the bottom. Look how far that is. It's from here to here. It's the same dimension all the way down. So from here to here, same dimension. So that's how strong the bull or the bear was. Now, one of the things that we forecast is how far can it move after it bottoms out? Well, we would say it could get back to fair value, but it wouldn't surprise us if it overshot. How far could it overshoot? Well, if they were able to take it this far, they may be able to take it that far. Now, they could only get halfway up, so there's more pain and suffering coming. But now notice that this time, they could only move it that far to the same price level, and it was only half the size of that move, and then it recovered. That was actually an indication that it could not fail further. And then now notice that it's even the pullback stayed above the 270, and it started to roll, and now we're getting higher highs and higher lows, and so now it feels like this, which is also indicated by the slope of the 270 after it bottomed out. So one of the things that you can use these moving regression lines for is to estimate how far away from the 270 you can get. So how do we do that? Well, we measure these maximum excursions and we compute what the max, the min, the average, and then plus or minus the standard deviation. And we can tell you shouldn't be surprised if it moves that far, but if it moves beyond there, this is an exceptional move, and you need to be mindful that it could change on a dime. Look how sharply those things change when the RL10 reverses. You have to pay attention to that. And then the confirmation of the RL30 is when you get the owl. The fifth indicator in the owl is when the RL30 reverses. The fourth is when the dragon reverses. So the owl waits for that turning point to be confirmed, and then it gets you into the trade in the correct direction. So the regression line fractal framework is one of the ways that we can evaluate what's going on. This is where you get things like a super pinch. Look at that. All four of the regression lines are in here, and so everybody agrees that's where the price is. And then what happens next? Well, price in the form of the RL10 leaves, and it tries to drag the other ones up with it. If it can do that over an extended period of time, then you see the 90 joining and then the 270 joining. So there is an art and a science to interpreting price action using the regression line fractals. We slow down the daily bars, and now we look at 3 bars, 3 days, and 9 days. So you've seen us use 3-minute, 30-minute daily bars, 3-day, and 9-day. There's a fractal relationship in all of those. The 3-day slows down that price action. Now we're still using the RL10, and you notice that we've color-coded it with the MACD histogram. And there's the 30. Look at that beautiful sine wave. The 3-day minimizes the impact of the overnight gap. And so it's a nice way to unclutter your chart. And then the 9-day, this is the turning point in COVID. And when that PSAR flipped, that's a 75% move. And now notice what's happened here. We get a double bottom, the PSAR has flipped, and now the RL10 is starting to pull away. That's a very favorable sign. That's a form of market classification. When it gets above this peak and it's close, that could be the sign of good things to come. So we would look at this as a turning point and this as a target. So now the 3-day and the 9-day sniper is a way that we can start using our standard sniper setups for those longer term buy and hold positions, which is of great interest to pension funds and hedge funds that are trying to minimize their trading. Check or hold? You've seen me talk about these every night, the 150-day look back. This is the one that we use to understand trade location for the sniper, looking at 3 different NDXs. The first one is the 150-day look back. Here is the 150-day high. Here's the 150-day low. So on the 150-day index, this would have a score of 0, and this would have a score of 100. This is the 30-day look back, and this is the 10-day look back, and those are the 3 look back periods that we use to identify trade locations for the sniper. I add for my own tactical trading the 5-day look back and the 1-day look back. And this gives me the ability on a single chart to understand long-term and short-term price dynamics on the basis of trade location. And what I'm looking for are extreme areas. So if I, on any look back period, things that are in the top 10% between 90 and 100 look extreme. Things between 10 and 0 look extreme. And then right around the 50-yard line, I put a bracket at 10. So when it's in the middle, if it's at 60 and 40, I know that there's 3 groups of 10 before it becomes overbought and oversold. So there are some of our sniper patterns that work when they are perfectly balanced in the middle of their look back period and could equally go in either direction. That's what we mean by the fence sitter. But on the other hand, I'm also very interested in ones that have moved to the top of their look back period, because those could be fireworks that are continuing to go, or it could be time for them to collapse back to the mean. By the same token, those that are oversold could be set for further collapse, like a collapsing dragon, or maybe it's going to recover back to the midpoint. So we have 5 or 6 different patterns that we use strictly on the basis of trade location to give us some insights into trading. Now, what you see me using them for mostly is this 10, 30, and 150-day look back, but the principle of using those 3 time periods applies in other time dimensions as well. This is just a zoom in on the last 30 days so you can see a little more closely, and then this is the one you see me using every night for the 30-minute swings. This is what I love. I love the 10-day look-back period because I can see 10-day lows and 10-day highs, and I can see 1, 2, 3 legs, a pullback, a kata 2, and go, and the 30-minute time frame is easy for me to manage. But I also get to front run swing traders who are only using daily bars. I get 15 bars between the open and the close, and that gives me 15 times the information and 15 decision points where I can do things, whereas the end-of-day trader only can make decisions on the basis of 1 data point. So there's a clear advantage, but by the same token, it's 10 times slower than the 3-minute chart. So it's a little easier to manage a lot of different symbols. All right. Now the next portion of the weekend report has to do with the blended monthly rebalancing portfolios. So this is the BMR system. The blended monthly rebalancing system is based on a blend of the 3-month percent performance and the 6-month percent performance, and those are multiplied. The 3-month times 0.7 and the 6-month times 0.3 gives you a blended score that favors the closer performance by about 2. That gives you a composite score. And then we rank those members by that composite score. And the blended monthly rebalancing is concerned with holding positions for a month off the top out of the top 3 positions. the moving average signal says if it's above or below its 4-month moving average. So if this was the end of the month and I was looking for the ETF 13 portfolio, I would rank it by the blended monthly, and I would check the top 3. And if they were each on a buy signal, I would own I put 1/3 of my money in each one and hold it for a month with a 10% trailing stop. If one of these was strong but was still below its 4-month moving average, then that position would go to cash. It would not roll down to the next one. And then that's the blended monthly rebalancing. Well, it turns out that I like that so much that sometimes I want to front run and see what's going on. So I added a 1 month and a 1 week to see if I could get a front running, or I could just start using that same methodology to see what was hot and what was not. Like right now, treasuries have been on a tear, and that's been very tradable, whereas Latin America has been getting murdered. So this is an example where a system can also provide information. This one is the ETF 13. ETF 22 adds the sector spiders like XLB for materials, K for tech, and so on. And that gets you to 22, and it's scored the same way. The ETF 32 takes the ETF 22 and then adds 10 more things, like it adds gold and silver and Australia and I think, let's see, agriculture, China, oil exploration, real estate, and so forth. Clean energy, all of which are tradable. And it gives you very clear distinctions between what's working and what's getting slaughtered. Like you might use this to find the things that are weakest to set up short-term intraday or swing shorts when they start failing, like collapsing dragons. That has nothing to do with the blended monthly rebalancing system, but the same lens that allows you to rack and stack these things gives you the ability to find things that are getting punished in the market, and I may be able to exploit them like we have been doing with clean energy lately. Check or hold. I also then run this on the Dow, the modified Dow, so that I can get a feel for which members of the Dow are really contributing to that index's performance. Look at the difference between the different members of the Dow. Like these have been getting smoked, but Apple, Boeing, Intel, and Microsoft in tech are crushing it. So you could spend all your time just trading DIA and get the blended performance, but if you're doing that anyway, you might want to know which ones are at the top and which ones are at the bottom, because you might be able to leverage that information into some very good trading opportunities. And you might not even have to look any further. Like I'm very interested in Amgen making its turnaround. And wouldn't you be interested to look at Johnson & Johnson and say, maybe this is an indication that its horrible underperformance is going through a significant change. And at those turning points, when they bounce off the bottom, it's not unusual to see that momentum shift sharply and become tradable on shorter time frames. So you get paid by finding the extreme conditions, because extreme results come from extreme conditions. I then use that same logic to look at the ETF Max, which considers about the top 185 most liquid symbols. And I give you about the top 30 here. So this will get you some narrowly defined sector funds like gold miners and Dow Jones Tech, Germany, Italy, Euro-Pacific. So you can get narrow and broad. And then I also take an extract of the bottom 10, the ones that are getting slaughtered the most, like United States natural gas is just, Can't stand it. But DBE, the energy, may be experiencing a short-term bounce. I could take that information, and I might want to just trade it directly, but I might also want to go look at ExxonMobil and Chevron and Devon Energy. I can use that information to tell me something about the condition of the sector. So I said before, market, sector, and company target, if you will. So I can use something like this to understand a sector, and that may lead me through a logic chain to individual companies that I prefer to trade. Check or hold. Now what I'm going to do is I'm going to come up with this world market model review, and what I'm doing is I'm taking the ETF2 performance model, which looks at three things. It looks at the average, the strength, consistency, and quality. So it's going to measure relative strength on a scale of between 0 and 100. And what it does is it uses the blended monthly rebalancing blend of 70% of the 3-month plus 30% of the 6-month. It blends those together into a composite, ranks everything in the database from best to worst, assigns the best one a value of 100, the worst a value of 0, and then calibrates all of the other ones on that scale of 0 to 100. So the strength column represents the current reading each week of the blended monthly rebalancing formula. Check or hold. What you're getting tonight, by the way, is about a $4,000 workshop. Now, the next column over is the consistency. So what I do is I compute the last 10 weeks. Imagine that had 10. And for each week, like this week, last week, all the way to minus 10, I compute the blended monthly rebalancing strength index, and then I count up for each little symbol. I have a little proprietary weighting mechanism, and then I do a blended score of their performance over the last 10 weeks. And then I scale that again on between 0 and 100. So that gives you approximately the consistency of strength over the last 10 weeks, which is then also indexed between 0 and 100. The third column that I have in here is the quality. So I take the last 40 weeks, and so week -1, -2, all the way to -40, and I compute the gains and losses of each week as if it was a weekly trade and an individual R multiple. And then I do a system quality number rating on those 40 trades. And then I take the one that has the best system quality number and give it a score of 100, and the worst is a score of 0. So we index the 40-week system quality number of every symbol in the database, and then we score that on the basis of 0 to 100. Check or hold. So what we have now are 3 independent measures. Sometimes I like to know current strength. Sometimes I need to know the volatility adjusted returns. And maybe I want the 10-week smoothed relative strength. Each one of those gets scored on a scale of 0 to 100. And then the average is simply the mathematical average of those 3. So if I were to take 63, 68, and 63 and average them, I would get 65. Now you notice that there are color codes in here. In each one of those 4 columns, I score them between, the first 3 are scored between 0 and 100, whatever. But I find the average and the standard deviation, plus or minus 1, and then those get color coded on that basis, so that the top 1/6 get a code of green, and green is very good. White, if it's above average and between average and plus 1, it gets a code of yellow. If it's between average and standard deviation minus 1, and then it gets a color code of red if it's in that bottom. So things that are red are in the bottom 1/6 of the database. Things that are in the middle are in the middle 2/3. There's about a third and about a third here, and there's about 1/6 and 1/6. So if you see something like Europe that is green all the way across the board, that tells you how strong Europe has been. And now compare Europe and the Euro-Asia blend to the S&P. Was there anything in your worldview or on your radar screen that said for the last 3 years you'd have been far better off with your buy and hold money in Europe and Asia than in the U.S.? No, probably not. And then if we come down here to the S&P, we do the same thing, only now we're tracking it with the XL series, and we're comparing those to the S&P. So I can tell you right now that on the basis of strength, technology is crushing everything. Finance has been murdered because of the bank runs. Discretionary, staples, and materials are doing okay. Utilities and healthcare and energy are below average. So I can get a quick sorting mechanism. Now for each one of those, I'm computing the 4-month moving average and finding that's the moving average filter from the BMR. And if it's above its 4-month moving average, it gets a buy rating. And so there are 6 of those 10 are on a buy rating, and that's why this week the scoring is 60% invested and 40% cash. 1, 2, 3, and 4. Last week, that was tilted 40 invested and 60 cash, so the market actually got 20% better or so in terms of reasonable asset allocation on the basis of individual indexes with their price relative to the 4-month moving average. Just because some people like to trade off of this chart, I just include the ATR and the ATR percentage to get a feel for volatility and also the size of the stop that they might use for a swing. I include, just for ready reference, market classification from the first page. I compare EFA to SPY to see whether it's the U.S. or the globals that are in the driver's seat. And then among the 4 U.S. indexes, the S&P, tech, mid caps, and small caps, right now tech is best at 90, and I'm using the strength column. Tech is best, then the S&P at 70, then the mid caps at 58, and the small caps are lagging for the week ahead. The 2 strongest sectors are U.S. tech, 90, and the European 350 at 82. The 2 weakest sectors are Latin America is the weakest at 50, and U.S. small caps at 54. So in one densely constructed, densely packed table, I get a feel for the broad market. Now I put it over onto this. Now I do that market classification by Morningstar style box. Large, medium, and small caps, value, blended, and growth. And these are the symbols that I use to report the relative strength, the quality number the relative strength number of the Dow, the S&P, and tech. Gives you value, blended, and growth. And so this is all of the U.S. ETFs, and those are tradable. They're very, very liquid. And that's reporting these numbers from the strength column. So this 90 here is the 90 of the NASDAQ. Check or hold. So if this is the U.S. market, I look inside North America for Latin America and emerging markets, Canada, Mexico, and Brazil, the countries that I care about. And you can see right now, and if you've been following along the nightlies, you can see why I'm so bullish on Mexico. It's crushing everything. But Brazil has been terrible. That's a real difference of opinion. I look at the broad European region. That 82 is the 82 of IEV, which is the European 350 large caps. That's the equivalent of the S&P 500, except it's the European 350 large caps. Here are the countries of Asia. Here is Japan and Asia less Japan. Here is Europe. Here are the countries of Europe. Here are the other asset classes that don't fit into a geographic category, but into a style box. Commodities, oil, gold, silver, long-term treasuries, that's TLT, corporate bonds, U.S. real estate, and private equity hedge funds. And then I look at the U.S. business sectors. Those numbers are these numbers. So now what I have on this page is the world market model at a glance, the 10 big indexes that drive the BMR and the ETF2. I have an extract of the S&P because sometimes I just want to know what's working inside the U.S., and this is what drives the ETF22 portfolio because it's the S&P compared to the 9 sector spiders. And then I look at the broad asset classes over here. I look at the equities, S&P, treasuries, real estate, blended commodities, gold, and oil. And as you can see right now, on those broad asset classes, gold is at a 5,000-year high. Did you know that? Oil's not bad, but it has been terrible. It's on a recent rebound. That tells you there's a swing trade still available. That comes from the Saudis cutting 1 million barrels of oil production by surprise this week. So the price of oil's going up. Treasuries, not bad. S&P, really strong. Real estate and commodities are getting smoked. So in terms of market classification and market understanding, this one page, this regional report, plus the breakout of companies and sectors and asset classes, contains a boatload of information that is actionable. Check or hold. Now, notice that the numbers that I use here are coming from the ETF2 model, which drives a very specific rule set. So the model is designed to produce numbers which can drive action in a system. But those same numbers and that same model also give information for other systems, or to inform broad strategies, or just to complete my understanding of a complicated world. Check or hold. You guys are hanging in there really well. Now this is an extract of the ETF2 report looks like. The ETF2 system has a very precise set of rules that I constructed about 20 years ago, for a hedge fund that was using proprietary rules to help people with their retirement accounts. And it saved people millions of dollars, and I feel pretty good about it. So what that one did was used a set of 10 ETFs and used certain rules about how to get in and get out and which ones could be owned and trailing stops and when you add money and all that other jazz. But I like the methodology so much that I expand it to include all 185 of the liquid ETFs in the world. I take a look at their average volume and their price, and I want the 185 most liquid ones. And then I rank them all on strength, consistency, and quality. And I use that same categorization of scores between 0 and 100 on the 3 indexes of strength, consistency, and quality. I score them with color codes on the basis of, I can tell you right now that each one of these scored, that 75 was the cutoff between the max. So the maximum score of the 108, there's more than 185 in there. I have some that are less liquid. So it doesn't, some of those less liquid ones have a score of 100, but it's not liquid enough to trade with size. But the best score of any ETF out of the 185 liquid ones is tech at 95. And then the cutoff between max, average, and the minimum score, the plus or minus 1. So this is the ones that are color-coded green. So that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12, 13, 14, 15, 16, 17, 18, 19. So about 19 of the liquid ones fall into that top categorization out of 185. So that's really only about 10% of the most liquid ones are in that top category based on strength. And then you get so this gets sorted by the strength column. Now, when I'm considering strategies for swing trades, this is how I do it. This is not the ETF2 system, but it uses the same model, check or hold. So what I'm considering is the strength column, which is current relative strength using our methodology, and then the 10-week rolling average of consistency. And so I'm looking at these two columns. Now, if something is in the green and the green, that thing is great. Like all of these above this line right here are great because they are green and green. What is my strategy? What's a recommended strategy for those? Well, they still are great, and you can reinforce them with trend following. So what I'll do is I'll go to the chart, and if XLK is in like a Kata 2 pattern, man, I will buy that and pound on it with a high priority and go, because all of the long-term and consistency stuff is good. Even its quality number is great. So I'm going to reinforce trend following, and I can do turbo on it, meaning intraday or even short-term swing trading. And why? Because the winners are continuing to win. The next category that I like is green and white. And why is that? Well, because it was good. It was white, like this one, VUG, the Vanguard Growth. It was white on a consistency basis. So it's above the average in the database, right? So here's the green, it's more than one, and here's the average. So it used to be in the white category on the 10-week, but the 1-week category, it's bumped up. So that means it's accelerating short term. So it was good and is now great, and now I have a chance to exploit new strength, and I can do turbo on it. Why? Because it's new leaders. By the same token, things that were green but are now just white, like the EAFE, that's the Euro-Asia Value Index, that used to be great, but it's starting to lose steam. It was great, now it's just good, so I want to make sure that I'm preserving profits, but watch for resumption, because that could be like a COTA 2, like it's decaying right now, but if it were to start to get better, maybe there's a COTA 2 possibility. So preserve profits, but watch for resumption. It would be easy to believe in it because it's like a COTA 2. It's just a second wind. And you can read the rest of this easily. But the things that I really like are these. I love red. It is terrible. That's like Brazil or natural gas. And that's like a collapsing dragon to the max. I also like red-yellow because it used to be just weak, and now it's terrible. And it is now a new weakness emerging, and that could be failing and now falling off the table. The ones that are kind of in the middle, not so much. I really like to concentrate on the extremes because that's where you get the biggest bang. The ATR percentage is also comparing them on the basis of volatility. So guess what gold miners are great at? Not only are they great, but they have such a tremendous ATR percentage that it's extraordinarily liquid, extraordinarily volatile, and off they go. So on a page, this one is really geared towards understanding the relative strength winners because it's easy to pile on the winners and trend follow. This tells you everything you know about what is great, what's getting better, what is starting to decay. Notice this one here, IVW, Growth Index in the S&P. It is white and yellow. So it was below average. Now it's above average. That's a sign of it was weak and now it's good. It's becoming new strength. It's not as good as green and white, but it's moving up. And that might be a way to front run some of the things that are going to become leaders in the future. Catch them earlier at the turn. Check or hold. Now, in addition, just because I include that MA signal, because we like the 4-month moving average anyway, I just include it in here, and it tells you in a nutshell how good that thing is or not. Look at South Korea. It's the only one on that list that's below its 4-month moving average, but it is becoming better than average across the board. That may be something that got smashed and is now on a early stages of recovery so that it's above average, but still has room to go to the 4-month moving average. That could be a long-term value play. Now, who cares about that stuff? Guys that have to take positions for months and quarters at a time and can afford wide stops and many positions and are looking for slight, subtle edges. Who does that? Pension funds and hedge funds. Buying them when they're out of favor, learning how to take profits when they become perhaps overheated. So your time horizon now determines what kind of trades you need in order to build out your portfolio. The last page on the weekly has to do with the tradability, the short-term tradability of the most liquid ETFs. So what do I do on this last page? I take the today's price times the average volume of the last 30 days, multiply the average daily dollar volume, and then rank all of the ETFs in the database, and I select out the top 30 by average daily dollar volume. Most liquid to the least. Every one of these is easily tradable intraday because of that volume. And then I look at the ATR percentage and I say, which ones in our standard four color codes, the ones that are in the green are exceptionally volatile compared to their peer group. The ones that are in the red are exceptionally unvolatile or quiet. Yellow is below average but not painfully so, and white is above average but not exceptional. And again, you get about 1/3 of the data falls inside here. So in the band of normal, you get 2/3 collectively, and then you get 1/3 on the outside. It's from these extreme conditions that you get extreme results. So which are the ones that are both very liquid? Well, it's on this list. It's liquid. And which ones are very volatile? These make the best short-term traders. Oh, energy, regional banks, semiconductors, gold miners, oil exploration, Brazil, and biotech. Now, the Russell and the techs are not bad, but nowhere near as volatile as these exceptional performers. But you can trade these with futures and tremendously liquid, and the same with the S&P tech. This would it surprise you to know that the tech companies in the S&P 500 are more volatile than the NASDAQ? And that utilities are more volatile than the NASDAQ? Would you have bet that? Would you have bet that gold is much less volatile than the S&P and the techs? No. So this gets updated every week, and this helps me decide which ones are the best targets for trading. So that completes the first 13 pages of the weekend report. So these are the weekly updates based on all those indicators and market conditions. The middle section is going to be the ETF2 database for all those 185, I think it is, the ones that are very liquid. And then we're going to see the daily report. So now when I come down to the next 2 pages, all that does is fleshes out the liquid ETF. It gives you the full report. So before, what you saw was like this top portion, because this was all of the relative strength leaders and whatnot. I excluded the middle, and I excluded the ones that were worst and were getting their brains beat out. But and the reason for that is that most of the folks that are looking to use that slower system just want to trend follow when the market is good and who are the leaders. But if you are more aggressive than that, you might actually want to do some short side trading on things that are really bad, like Brazil, regional banks, and the big broad bank index itself. And things getting much worse, like real estate and biotech. And then you can see which ones are above or below their 4-month moving average. And you can see which ones are have the greatest volatility for ATR percentage and stuff like that. So now if I zoom in a little bit, you can now start seeing how these different whoops, that was too big, sorry. You can now start seeing how those different strategies from that previous page, like the green, and then the green whites, the white greens, like this one is starting to slow down. This one's starting to improve. And now this gives you the ability, you can actually watch the things that were horrible week over week start marching their way up until they become the leaders. And if you are tuned into that 2-page report once a week, in a matter of a couple minutes, you can see which ones are on the move and in which direction. Is that thing moving up, or is it moving down, or holding steady? Who are the new leaders? Who are the dominant leaders? And that will never let you get surprised by what's working in the market, because this is quickly adaptable to changes in market condition and price action. You cannot hide a change in relative strength from this lens. It is my go-to quick way to evaluate what's going on in the world. Check or hold. You guys are doing a great job hanging in there. So now what we've got is we've seen 2/3, the first two sections. We had the weekly indicators, and then we had 2 pages of details on ETF2 using those 4 categories: strength, consistency, quality, and the blend, with the color code scheming and the relative to the 4-month moving average, and some information on the ATR percentage and its liquidity information and all that jazz. There's our little buddy SPY right there, right in the middle. Almost always in the middle. And when I'm looking for bottom feeders, these are the things that I look at. All right, so now we're going to look at the daily report, which you guys see me reviewing every week, selected portions of it. So page 1 is this one. It's this table.